Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is program show host Richard Benuli. Today is Thursday, February 22nd. We have Larry McDonald and Ira Harris. Larry is the founder and editor of the Beer Traps Report, an independent macro research platform focusing on global, political, and systemic risk with actionable trade ideas. The firm also offers a live institutional Bloomberg chat service with over 650 institutional investors on that chat. As a former VP of distressed debt and convertible securities trading at Lehman Brothers, he wrote a book on the fall of the investment bank titled A Colossal Failure of Common Sense. And he has a new book that's coming out next month called How to Listen When Markets Speak. And we'll get into that shortly. Ira is an independent trader, hedge fund manager, and global macro consultant trading foreign currencies, equities, bonds, and commodities for over 40 years. He was also CME director from 1997 to 2003, and also a stint there most recently. Welcome, gentlemen.
Hi, thank you for having me, gentlemen.
Well, thanks for putting us together, Richard. You always make things interesting, so let's get interesting.
Great. Thought we'd begin first with your view, Larry, on the global macro view on the economy and the financial markets.
Well, today's probably a historic day because you've got this incredible move this week in NVIDIA, and the amount of capital that's in financial assets relative to hard assets. You get close to 22 trillion in the NASDAQ 100, and you only have in all the oil and gas companies and all the metals combined and all the uranium, you have less than $2 trillion combined. So it's really a massive overdose of financial assets. And a lot of that is driven by expectations of lower inflation. And we've had Fed governors this week come out. They're still pounding the table on, that 1-2% inflation regime. But behind the scenes, and listening to institutional clients behind me, we run a conversation each day with about 650, like you said, institutional investors. And there's a growing sense in the chat and belief that sustained stagflation probability is rising dramatically, say, the last 3-4 weeks. And I think that's going to be instead of looking backward at the earnings of, say, technology companies, let's look forward and, what does the planet look like a year from now?
So you're referring to based on that stagflation view of the institutional client chatter on the chat service.
Yeah, it's driven by labor costs. It's driven by it's not just supply chains. It's just a different world now. It's a multipolar world. This is the main thesis of the book. We sat down with James Baker, former Treasury Secretary, Neil Ferguson, the Harvard historian, and a lot of hedge fund managers that are friends of ours in the chat and around the world. And it's just that you've got just a multipolar world that's less easy to ship goods around the planet. And there's just a lot of sustained inflation drivers that weren't with us over the last decade.
Mm-hmm. Interesting. And your thoughts, Ira, on this stagflationary emerging environment?
I don't get into structuring things like that. Not that I don't have the background. So when I say stagflation, I don't know, but I'm willing to listen and learn. I mean, those are some powerful voices. And James Baker, who I may not agree with all the time, but I always respected him because when he walks into the room, he gets everybody's attention. He's and Neil Ferguson, who I've had the pleasure actually to meet and talk with, but I've read his work, his history of World War I, or actually more of the peace conference as much as anything. these are people who you want to pay attention to. And again, and I get the sense from Larry that it stimulates thinking to lead to profitability or to avoid bad situations, because you want to look at things from outside. I mean, that's the way I've always operated. I'm a fourth boy in line. I had 3 older brothers, so my existence was always looking outside in and trying to figure out where I was going to make things happen and how to prevent getting the crap beat out of me at the same time. So it carries over to my trading. So that's what Larry's trying to do. These are the right people, because you avoiding bad situations is probably more important than making the good ones, because your work will lead you to the good ones. It's the bad situations that undo a lot of really productive work. So I admire that. So let's ferret out what he's got, because I think there's some really important stuff there.
Yeah, can you go into detail, Larry, on the themes and the messages from the book, and also how it's aligning with what you're hearing in the institutional chat service?
Okay. Well, say 10 years ago today, the global population was about 900 million people less. And so 10 years ago today, so we've added almost 1 billion people, and we've taken 5 million jobs out of the United States. We've decimated the Rust Belt. There's fathers in the Midwest and in the Rust Belt that spend their days at the library and come home to their families, and because they just can't find a job. That whole manufacturing base has been hollowed out. But the good news is we've raised the standard of living dramatically in India, China, Bangladesh. And so if you're in India right now and you're a 25-year-old young man or young woman working in a call center, you're literally making probably 10 to 100 times more than your great grandparents, and but you're also a massive new energy consumer. You've got a moped. There's 1.4 billion people in India, and there's about 1 billion people 1 billion human beings that don't have air conditioning. So we are juicing. And this is the fastest growing energy consuming country on the planet. The fastest growth is in India. So whatever we do in the UK and the US and Canada around energy consumption is just a rounding error in terms of growth of carbon consumption relative to this, the planet. And then you look at AI, and this is just like the most hot smoking, crack smoking situation for energy versus demand that you can imagine. So everybody's freaking out today, and there's a massive celebration of the $18.4 billion what we call data center revenue that's coming from data centers to buy NVIDIA chips. $18.4 billion, and that's growing much faster than any analyst expected a year ago. So a year ago, NVIDIA in the first quarter bought 0 stock. So the NVIDIA brain trusts that are growing this company at that fact didn't see this coming, right? Because they would have bought some stock back. So in the fourth quarter of 2022 and the first quarter of 2023, which is a year ago, almost very little to no stock was bought back, and now they're aggressively buying back. So think of that $18.4 billion of exponential, explosive growth in data center chip demand. There's estimates out there, and we've talked to different consultants, but the estimate in 2022 that these data centers, this is 2022 now, the data centers would consume about 460 terabytes of terawatts of energy, 460. And the estimate for 2026 was supposed to be 1,000 terawatts. And now, you look at the growth and just listen to the NVIDIA call like we did last night, and that 1,000 terawatt estimate is probably off by at least 50%. So we're talking about 2,000 terawatts. You're talking about the energy consumption of 2 countries the size of Germany, just in data centers powered by NVIDIA chips. I mean, this is just exponential growth. At the same time, I'll wrap it up. The CapEx 10 years ago, when capital expenditures in oil, gas, metals, uranium was on a plane, a very significant trajectory. But since then, that trajectory from 2014 to today, we're down about $3 trillion of capital expenditures that we need to make those investments to run the planet Earth's energy demand, to satisfy the future energy demand. So we're $3 trillion in the hole on investments to find the energy, but we're also, massively exponentially increasing energy consumption in the emerging markets and as well as in technology. So this is just literally, I think, a very certain energy crisis, 1970 style crisis between, say, late 2024 to 2026. That's one of the main theses of the book. And thank you.
Interesting. Your thoughts, Ira?
Well, so we've actually done some podcasts through Financial Repression Authority with Doomberg and Adam Rosenweig from Goering and Rosenweig, who are, these are really good.
I like those guys. Yeah, a lot.
And Dr. I sat on one with those two, and then Richard was able to throw in Dr. Anas Al-Haluji, who, so I go, what am I doing here? This is like ridiculous. I was like the village idiot who showed up. But they said, no, we want to know your global macro. I said, I know, but I love that. And what you're talking about, and everybody forgets what it takes to drive these centers, these data centers, and they don't turn off. So
they don't.
Right? They don't. You can't turn those off.
No.
So it's interesting. I always wonder when I look at them and their pro formas, how they should be the ones building, small nuclear facilities basically on campus, right? Because that's, their fixed costs would be high, but they'll gain that back. The return on that would probably be, I haven't done the math on it, but would be recouped pretty quickly, because they're not going to battery storage, because they're not building wind farms there, and they're not building solar, because the amount of storage that they would have to, it would be there. I think the numbers would dictate that they have to go to nuclear, small nuclear. They may as well pay the U.S. Navy to get some of those nuclear powered ships and just hook into them and say, okay, this is now our power source, and it's the points you make. And then everybody expects the growth of the middle class between China and India and Indonesia. And for us to sit here, for our college graduates to sit there, in their apartments going, well, we have to go to a totally, no carbon, not going to happen, because as we see, India and China are building coal-powered plants. Why? Because Germany's taught them. When they turned off those nuclear plants, and now all of a sudden Germany's burning that crap brown coal that they were trying to get away from, they're not going to get caught in that situation. Everybody who wants to dictate to them, not going to happen, because you get into the works of, well, where you're going, and Vaclav Smil, energy and civilization. And Rosenweig has been great with that. You're not cutting that off. Once you get a taste of it, once you get that air conditioner, once you get that computer, you want power. And it's just not these whole decarbonization. Yeah, it's great, but it's going to be very expensive. And the emerging world, or what do we call it this week? The emerging world, it's the global south this week. They're not backing off from this, and you're not going to tell them they can't partake of this. They've got the taste, and rightfully so, as you talk about the growth in the middle class, the jobs that moved out. And that's the political conundrum that Donald Trump tapped into. He tapped into it in 2016 and paid attention to it. Nobody else, everybody gave it lip service, but nobody really paid attention to it. He says, huh, well, he had Bannon on his shoulder. So Bannon was certainly very aware and of what was going on. And Trump was willing to go with it because he looked at the other 15 people up on the platform. What am I doing with them? These are all professional politicians and they're going nowhere. So I may as well pivot my way. And he did. And he scared everybody. But that's what he tapped into, because globalization, and I'm a globalist. I've made my living being a globalist, hasn't worked for everybody in the same way. So I see that's where you're going. I think that's from what you've already said. So we may as well go down that road, because that opens up a whole lot of discussion about many things.
Yeah, and then we think about the Fed, like, okay, what's the Fed going to do? And in the chat, one thing I'm hearing is the data points on commercial real estate, the marks. So Japanese banks, they have a very formidable, serious marking to market of their foreign assets. So if you're a Japanese bank, they really make you mark your foreign assets to market aggressively. And so in the last 3 weeks, we've had Tokyo Marine, Aurora, and then in Germany, I think it's PBB, and then we had New York Community Bank, and then we had HSBC I think it was yesterday.
Yeah.
All of them are marking their mark to market on their commercial real estate down. And this is just the beginning, because if you look at companies like MetLife has an investment portfolio of $650 billion, $640 billion as of the last data I've seen, and they have about $100 billion of commercial real estate, and the stock's at an all-time high. So you can see that within the banking system, companies like U.S. Bancorp, M&T Bank, they've rallied a lot off the lows, but we have probably an emerging situation where we have potential stagflation in terms of inflation revival in some of the data, but at the same time we have real credit risk that's kind of creeping into the banking system. So 6-9 months from now, you're most likely going to have a Fed that's forced to stop. And I think we're going to get rate cuts, aggressive rate cuts, when the job on inflation is not done, and a whole bunch of different asset classes do well in that world.
Is there an implication that it would be a challenge in the financing of projects that would be necessary to meet the data center requirements, linking back to your book in terms of the infrastructure and the energy that is scalable enough to meet the requirements?
Well, there's a lot of empty space, so there's a lot of office space and space available for these data centers. So, and we're seeing massive conversions. The apartment conversion from office is at a record pace, and there's just too much office space because of a bunch of different things. Number one, you've got a new interest rate. When you suppress the cost of capital for over a decade, like the Fed did, and then you have a free market-driven cost of capital, bad things happen, because you just have $1 trillion of commercial real estate that's priced at the wrong price because the Fed suppressed rates at an artificially, screwed up, insane level. And now if inflation's revived, the Fed's forced into this new cost of capital regime, and that makes a bunch of commercial real estate, I guess it just doesn't work at the previous existing finance, as that goes up basically 200 to 500 to maybe even 1,000 basis points, depending on where and what kind of company. So you've got much higher interest rate cost, and that just doesn't. The buildings just don't work. The financing doesn't work the same way, and so we have potential. Not a Lehman crisis, but definitely a credit event coming. Say, if you just do the math on all the high yield bonds, all the leverage loans, all the commercial real estate, it's about, and the investment grade and high yield and leverage loan commercial real estate debt, it's about $2 trillion of maturities in 2024 and 25. Now, some of that's going to be okay, in other words, refied, but there's a big chunk of it that's that's going to have a problem.
So some of the commercial real estate you're saying could be repurposed towards like data centers as one type of investment asset class to consider.
Yes.
Mm-hmm. And what are your thoughts on the actual energy input? As Ira mentioned, we've had Adam Rosenzweig. He speaks a lot on energy return on energy input investment required for that type of energy source, with solar and windmills being low, right? 5 to 1, 10 to 1, versus oil and gas like 30 to 1, versus nuclear like 100 to 1.
Yeah. Right. And
Mm-hmm.
that's this next gen equity. We recommended next gen. So we've been in the uranium trade since 2020. We've been very public on Twitter and with clients. And so we started off with a position in URA and Cameco. But what we've noticed is a lot of money in uranium, which is nuclear power, future, the whole bit. A lot of the money moved into the uranium commodity and to Cameco. And this is what you see in the beginning of bull market cycles with commodities or any type of bull market. They usually move into the mothership first. And there's not a lot of buying early on of smaller cap companies that are in the energy space. One company that we've been recommending, and it's speculative, very speculative, but it's Next Gen, NXE Equity, NXE. And, they just have this, most spectacular reservoir of reserves that, need to be developed. But in the Western world, one of our points of the book is that where the commodities are now in a multipolar world mean a lot. So companies that have great reserves in safe places like Canada, the United States, those companies, I think, will probably have a premium to other companies that have oil and gas and uranium reserves in more questionable, parts of the world. And as you can see right now in Panama, we do a lot of work in Latin America, and this is one of the most productive coal mines in the world in First Quantum. It's the most incredible property because it has such an immediate access to the ocean. So you can mine copper and get it out to sea, literally 1,000 times faster than you can in Africa, and so you've got these great properties that are being shut down around the world by governments that don't want the mining in their backyard. So this is another potential, not just potential. We're seeing the same thing in Chile, same thing in Peru to some extent. And the world is just massively, massively undersupplied, and it has a lot to do with political risk.
Mm-hmm. Your thoughts, Ira?
Well, so last week we did a podcast with Peter Bookvar and Chris Whalen, and we discussed, and Chris Whalen to me is standing on he's the best total bank analyst and understanding how it all comes together. And
I like Chris.
Yeah. His long history. I've known him a long time. So because Peter Bookvar has been talking about, what was coming. He was writing about it 3 years ago, as others were, yourself. So, the refinance when rates started going up, and we're coming to it now. Who's going to be able to absorb it? We're going to find out, and to be able to, and as both. I'm sorry. Excuse me. 1 second. Yes. Hello. Yes. Yeah, Mike. Okay.
And actually, Larry, if you wanted to elaborate on the industrial metals that form the themes in your book, other than uranium and copper, do you see other industrial metals that would make sense?
Well, just think of the top 10 companies market cap in the world today. It's mostly technology, right? It's your NVIDIAs, your Microsofts, your Apples. Microsoft and Apple are together, I think $3 trillion, and that's much larger than the entire energy complex. Just literally, I think so you've got 10 years from now, you're going to have a Rio Tinto, a BHP, you're going to have maybe not an Alcoa, but a Chevron in there. So if you think of like 1968 to 81, that's where we shifted from
He's frozen.
book, we had supply chains that were stressed around the world because of war. In that era, by the time it all finished around the early 80s, industrials, metals, oil and gas were 49% of the S&P, 49. And right now, industrials, materials, oil and gas, energy, uranium, they're only like 14% of the S&P. So we're definitely going back to a period where not to 49%, but 10 years from now, 5 years from now, you're going to have a lot of companies that own hard assets that are in your top market cap. And so those groups, industrials, materials, oil and gas, uranium, they're probably going to go from 14% of the S&P market cap composition to maybe 30 to 35. And that's the trade we got to really prepare for.
I see. Sorry, Ira, did you want to continue?
Yeah, I apologize,
yeah,
but I
no worries,
was waiting for that phone call, so I apologize. But yes, I think that's so much. And that was my education background with U.S. multinationals, and especially using an overly strong currency to be able to purchase loads of assets around the globe to put them into that situation. And I think, I think that's a good point as we are coming out of this. One of my favorite picks over the last 2-3 years has been Glencore, because nobody does dirty business, and now with Glassenberg moving on. Well, he's not really moving on. He's moving out, though, of running the company. I think, and Glencore this week announced that they were cutting their dividends, but to me, for positive reasons, because they were going to pay down debt. It's the problem with a lot of these companies. They take on a lot of debt in order to grow. And if they don't manage that debt well, they get into trouble. I mean, we see it over and over again. Hey, look at today, Newmont. And last week we talked about Newmont because lo and behold, in that F-13, Druckenmiller comes out and talks about how he's selling some of the more high-tech, high flyers and rolling into Newmont and Barrick. And when you look at this stuff, Larry, you do, it's the price of gold. And people say, "Oh, you're a gold." I'm not a gold bug. I wish gold would be $41.25, but that's not going to happen because that requires a level of responsibility of governments that we're never going back to, or unless it's forced. But it's not going to happen. But you look at this and you look at these gold mining, especially today. Yeah, gold's down a little bit, but I went back and did this work. Back in April of 22, Newmont was $82, $83, and gold was $1,930. Well, gold's $2,030, and Newmont is at $31. So you see these disconnects, and when you go around the globe, paying attention to these disconnects become very important for investors. Is that what Druckenmiller's onto? Maybe, but when certain things like this happen, you have to pay attention, because is this a warning that maybe gold is just so overpriced, and the equity end of it gets it? I don't know. Or are the equities just so badly mismanaged that a high price of gold isn't even a good enough catalyst to bail them out? But I only care about it for investable opportunities. And now, again, to avoid the pratfalls that these may present. Because one of these are wrong. Either the price of gold is indicative of being too high, or the mining stocks are the greatest. There are things that get left behind. As everybody takes stuff off the table, then what do they look for?
Right.
right? But of course, the underlying has to be a quality company, and they have to be qualitatively managed. So when I see Glencore cutting dividends, not because they really have to, but because they're trying to get ahead of their debt situation and keep it from being a liability. So they'd rather tell the shareholders, you're going to have to wait. We paid you out very nicely. It's been a 9-10% yielder on top of an appreciating stock. What more would you like? That's like being long the Brazilian real for the last year and a half. You got paid very nicely for waiting, but now you're not going to get as much capital return in the short term. But we're going to do, and this is a word that has, of course, disappeared from our lexicon. We're going to act as a fiduciary and be responsible for the longer term, and that's gaining control of the debt. So,
yeah, I think the way I look at gold is it's at the end of a hiking cycle. What happens is when the Fed's hiking that aggressively for 18 months, at the same time, global central banks are buying gold. They're not really buying the miners, and so there's a lot of central bank buying. But what happens is in the early stages of a bull cycle, especially with, like I said, with uranium, same thing with gold, people will hide out in the mothership. And so what happens is you get this big overvaluation of the commodity versus the companies. The same thing today with the miners. So yeah, I agree with Druckenmiller. The buys here for Newmont, especially Barrick and Agnico, are screaming buys down here. Now you do have the Newcrest acquisition at Newmont, and you do have some cost overruns in the last if you look back at the last 3 quarters, there is some disappointing management failure or operational failure in some of these companies that disappointed investors relative to past cycles. But the companies are much less levered, and they're generating, free cash flow at an incredible pace relative to historic data. And so the value, if gold, if gold itself has been consolidating for almost 2.5 years now, around that 2000 level, and so you're going to get a move here probably in the next year where the Fed gets forced into cuts when they're not really done on inflation, and it's kind of like a stagflationary environment. Like jobless claims came in okay today, but continuing claims are like at 18 months. I think it's 1-year highs, and so you've got a lot of job losses around the U.S., deteriorating economy. You got a potential crisis in the banks with commercial real estate, and so all this forces the Fed into rate cuts that gets you a year from today a much weaker dollar, and that gets you, a big probably move up in Barrick and Agnico and Newmont.
So so I'm glad you brought it up, because you were going that road before, and we were talking about the Fed. And one of the Fed, to me, and this is what we talked about, I meant to, when we talked about with Whalen and Bookbar the other day, we talked about our star. And as long as we're having this, our star to me, and I'm a Marxist Austrian trained, and when I was in graduate school, that's what I studied, but both, because I had professors I was at the University of Wisconsin in the mid-70s, so I had, in graduate school, so I had professors who were, very openly and would teach you. It didn't make them art, but they would teach you, but they also taught you the Austrian school and the concept of debt. And so, it was the Marxists who saw what was happening in the third world loan situation. That's where I learned how to pay attention to that and learn how to navigate those fields, because they saw what was happening with the massive loans for energy imports. So Saudi Arabia would recycle the petrodollars into Citibank, Chase, all the big banks, and they would be relent to sovereign governments who were importing in the what we called the third world countries then, importing massive amounts of energy and paying a hell of a lot of money for it and taking on debt and debt. Okay, so we're there. But in today's R-star world, with the way the Fed has moved here, so I look at real yields. and I look at overnight and short-term real yields, because the lesson of Volcker is if you want to crush inflation out of the system, raise overnight rates high enough, quick enough, and you will crush inflation. And then the longer duration will react to it in some fashion. And they will eventually move to follow it. So when I look at our star today, so let's say that inflation is 3.1, 3.2, 3%, and you have overnight rates at 5.25, 5.37. So you're running a real yield in that realm of about 2.5%. Now that's probably the historical norm if we go, if we take enough time and look at it. But the amount of leverage, because of what you pointed out over the last 15 years, and that's what none of the central banks pay attention to. This system is levered up and can't withstand. They need negative real yields. They don't need positive real yields. And that's, I think, why you get to the stagflation, because how else, if you maintain real positive yields of 2% for another year or so, you are going to run into, as Buffett would say, you're going to find out who's swimming naked. Well, there's a lot of people out there swimming naked because the leverage factor is so great.
Right. And the consumer, if you look at the Walmart data, like Walmart equity goes up typically, especially when times are stressed, when consumers are stressed, because they steal market share from a lot of competitors. And you saw this with the McDonald's numbers, you saw this with Kraft Heinz. People, like middle-class families, and it's an election year, they're really stressed because everybody's heard the stat. Like the New York Fed has told us 1,000 times, like 25% of American families, maybe up to 30%, only have $400 in a checking account. At the same time, we've got $6 trillion, Ira, in these money market funds. So the people in Palm Beach, the money market fund, a guy with $10 million in a money market fund, he's getting $550,000 a year of interest. That's up 300% over the last since 2021. Right. So, or if you have $1 million, you're up near $55,000 of interest, and that's up from like $9,000, maybe $10,000 in 2021. So that segment of the population is doing great. But the bottom 30% only have $400 in the checking account. They're getting a massive amount of stress. And that's where the Fed's got a big problem in an election year, because that group is, and you can see it in a lot of the data, whether it be auto financing or all kinds of delinquencies that are rising in many different spots in credit cards, because that bottom 30% is under tremendous stress because they only have $400 in the bank, according to the New York Fed, and their cost of living is gone through the roof since 2019.
Yeah, there's some great points there, Larry. And what are your thoughts on the actual U.S. yield curve, short and long end, in terms of trends?
Well, the curve is being distorted by Janet Yellen. Okay, she's really, she and Mnuchin have put the country at risk, because the last two Treasury secretaries have been like leaning and issuing tons of T-bills when they should have been issuing longer term paper to lock in rates. So now we've got a tremendous amount of issuance. And this is really cool to think about. I want everybody to understand this, because you can juice markets this way. So let's just say you need to sell $2 trillion of treasuries over the last 2 years. If you had sold a lot of longer dated bonds, say 10 and 20-year paper, if she had done that, those bonds, because interest rates went up, would have gone down. Like a 10-year bonds movement in price relative to a 5-month, 6-month T-bill is like 1,000 times more, right? So if interest rates go up, your $1 trillion in the T-bill doesn't move, right? It keeps its value because it matures in 6 months, whereas your $1 trillion in 10-year bonds or 30-year bonds, we've seen there's an Apple bond that was issued by their genius Luca, their genius CFO in 2020. It was trading, I think, in the 50s, because it's like a low coupon and it's a longer dated bond. I think now it's trading in the 60s. So that's you're talking like $1 billion that's now worth $650 million, but it's actually $2 billion. So just to keep it simple, $1 billion bond is now worth $650 million, and that's so what Yellen has done is quite brilliantly, and she's supporting, trying to support the president in an election year. She's in the sense of she's suppressing volatility in some respects because she's issued so much T-bills, and that's creating this. That's why the economists are going crazy, Ira, because they're looking at this 2s10s and its inversion for such a long period of time. But one of the reasons why it's inverted for so long is she's pushing up the T-bills because she's issuing so many T-bills instead of longer dated bonds. And it really puts the country at risk, though, because if we do have sustained inflation, they're going to have to refinance all those T-bills eventually at higher yields. And interest on the debt now is $80 billion a month. $80 billion a month. So where are we in a year or two? It's going to be 100, 200 billion a month. Not 200, but 100, 110, 120. That's over $1 trillion. That's over $1 trillion a year of interest, right? So it's and that's dwarfing the defense budget. It's dwarfing Medicare and Medicaid at some point, and it's really going to create. That's where you get into this stagflation problem, because that's when the Fed gets forced into yield curve control, probably early, I think maybe 2025 at some point, where they have to at least suppress some part of the curve.
If I may, Richard?
Yeah, go ahead. Yeah.
So Larry, we've had this discussion on this podcast for at least 18 months, because once they started jacking rates, maybe a little longer. So we've talked about it several times. We've talked about it because the politics of once you, and we're there faster than anybody thought would happen. Once the interest on the debt supersedes the defense budget, you have real, forget stagflation, the politics of it are terrible. And yes, how are they going to figure this out? And yes, it's not often I find myself in agreement with Larry Summers, but when Summers back in 2020 and 2021 was screaming at them, issue more 50-year, bonds, fund it as long as you can, as long as, as they say in the markets, when the ducks are quacking, you got to feed them.
Right.
Feed them. And she, especially as rates have gone up, she's front loaded so much of this T-bill market. And I would explain to people, this is a huge transference of wealth. And I know Lizzie Warren and they're not happy about it, which is why I'm waiting for we'll get to that, but they wrote those letters to Powell, right? On January 30th and 31st, the same day as the Fed meeting, you had the 4 from the Senate Banking Committee, Lizzie Warren, White House. They wrote a letter to Powell telling him to cut rates. Now, it was interesting that Sherrod Brown's name was not on there as chairman of the committee.
I missed that. Thank you.
But the next day, he came out with his own letter to Powell.
Did he?
Yeah, pushing for rate cuts. So that was really interesting. So I'm waiting for the Humphrey Hawkins testimony, because this ought to be pretty hot. And now that Powell has, pivoted to a more hawkish stance. So I want to see where they go with him. This will be interesting. But all of this, again, we've seen this, and I applaud you, because here's Yellen, and I got into trouble on a podcast back in October with Mark Faber, who I love, and I know you've been around. So we've done 2 of them.
I did a speech with him in Abu Dhabi. He was so funny.
He's
brilliant.
I'm telling you, we're sitting there. He's sitting in his pajamas from Thailand. And then he starts lighting up cigarettes. Like I thought I was, doing I was on with Ricky Ricardo on an I Love Lucy, but my respect for Faber is so great. But and I had the temerity in his mind. I said, well, Yellen is really bright and intelligent, and he took great umbrage to it. But that's okay, because we came to the point as to why I understand it. And yeah, she's playing a tough game, but I think her timeline is kind of at the end, and they could be in a real difficult situation. But because your knowledge of the Fed is so deep, one thing that drives me crazy is, how is Powell able to get a unanimous vote? There are 4 governors that were appointed by Biden who are all labor economists.
Exactly.
Labor economists. I've gone and read their research, because it's just the way I operate. And I know that historically, if you look at a labor economist, most of them are very dovish on monetary policy, because jobs are far more important than, a little bit of inflation. In fact, they would probably argue that if you went to 4 or 5% inflation and it resulted in an alleviation of some of the debt pressure, it'd be a good thing, because you're paying back with cheaper.
Yeah.
They all want.
Yeah, they don't. They want to monetize the debt, right, Ira?
They can't help them. It's just, it's for the most part, and these 4 keep falling in line and voting. It's one of the, it perplexes me. How is he able to hold this group in unity? And then when they come out and talk, like Philip Jefferson was talking today, you go, well, how is it that they keep voting the same way? You and I know, if we stood on a corner and there was a car accident and there were 12 of us standing there, would we all agree about the accident that we just saw and who was culpable and how it took place? No. And yet, unanimous votes. So I'm asking your opinion. I'm missing some, and yet it bothers me.
Well, I think we're far enough away from the election that they can stand by Powell. But I completely agree with what their premise is, that, the whole thing's going to fall apart in June, July, because if they don't get cuts ahead of the election, and you think about the strong dollar, like one thing that we did a lot of work on, the strong dollar in 2015 into 16 really helped Trump a lot, because the Rust Belt was, remember, Trump only won Michigan, Wisconsin, and Pennsylvania by like 140,000 votes. And it's a lot of manufacturing jobs in those states. So, and you look at manufacturing today in the United States, the data is recessionary. It's so, there's a lot of labor economists that want job cuts to get a weaker dollar. Weaker dollar would support U.S. manufacturing exports. Strong dollar, is very painful for manufacturing states in an election year. So I think that there's going to be a big break in the Fed, sometime, May, June, where those labor market economists start wearing their politics on their sleeves.
Okay, I'm glad, because I'm glad you said that, because it's really perplexing. This is and I'm glad you talked about the dollar, because I'm currencies and bonds are my primary. That's where I begin my analysis, and I go, so the currencies, all right, and I'm looking at the weakness in the yen at these levels on a global relative basis is just preposterous. I mean, we're seeing the move in the Nikkei, but I'm not sure this is, they want to blame it on the $150 yen, but it's kind of a remnant of the Abenomics, and you've had some corporate restructuring in Japan, which Lord knows they've needed it. Has it been aggressive enough? Well, it all depends who you ask, but if you've been involved in Japanese equities, it's been a pretty good run for the last 18, 20 months. So, but I really like your analysis, and I think that's right. But when do they come out? Because a vote of 9-3, 8-4 would tell me more than any press conference, than any interview on CNBC or Bloomberg. That would, and I'm waiting for them to find their solid feet, not clay, feet of clay, and start going, you know what? No, we want to do this. And if you're going to control the yield curve, you're going to have to cut short-term rates. You know, I know that's where Wayland's at, because you can offer to buy that, but the market's going to do it. If you don't do it, the market's going to do it for you anyway, because people are going to get a little nervous. And that's why I don't know why anybody would extend out duration now. Who's buying the long end of the curve?
Yeah, well, you know what? The Lehman crisis and the COVID crisis, duration was such an incredible trade. I mean, you could have bought long-term bonds and made like 20%,
right?
Because of the Lehman and COVID crisis. And so I think there's been some people that have been buying the long end that are looking at the inverted yield curve. They're looking at the banking crisis potential. They're looking at the commercial real estate, and they're thinking, okay, we get this Lehman/COVID type rally in the long end, but that's kind of like recency bias, where I'm more leaning toward what you're. I think you do get some rally, but you know, the days of you getting like a rally, you know, down on the 10-year below 2.5% are over. I think for the rest of my lifetime. And so right now you're on 10s. You maybe get a rally 3.5, 3.25, but a year from now, when they start cutting and then you get a revival, then you're going to be back up near close to, you know, from 4 to 5%. And that's where the Fed's going to have to step in and do something, because at 4 to 5% on the long end, it's really, you know, hard impact on a lot of financing, especially real estate and banks. So that's where they probably have to stop on yield curve control. One thing in the chat I heard this week in terms of currencies, the won yen. So the yen versus the won is breaking out to an all-time record level, and so that's yen weakness, which is, you know, really the last time the yen was this weak versus the won, China devalued, and that because what happens is a weaker yen, you know, they're going to steal export market share from all around the world from China, and China's pegged to the dollar, as everybody knows, and so at some point that thing breaks. So that's something to watch. If you make sure you keep an eye on this. I know a number of, you know, hedge funds, and so what the clients do is it's like a live ideas dinner behind me. We have a conversation, and in the old days we would go to Ben Benson's in New York. We have a steak, and my assistant would be in the back taking notes. And it's like you get a long equity guy versus a credit guy. You have a debate about either currencies or equities or commodities or high yield, whatever it is, on the, you know, whatever is more topical. And we have this conversation. And I notice what I do is I track the trend of the conversation, and we're getting definitely more people that are talking about this yen won stress, which that's something that, you know, that we really got to keep an eye on.
But we discussed that, so I'm interested because I've never heard anybody. But I keep that stays up on my board right now, so I know exactly right now as we talk, 20.93 yen to a yuan, which is the highest we've been. Well, you know, if you go back to when the Chinese did devalue January 1st, 1994, when they devalued the yuan from 5.8 to 8.7, happened to be the same day that NAFTA started.
Right, little Bill Clinton, God bless him.
Yeah, NAFTA starts January 1st, 1994. The Chinese devalued the yuan. And then Mexico goes into crisis with the tequila crisis of 1994-95. So when you don't think that they watch, and they know exactly what's going on here. And I'm surprised the Japanese have not gotten more pressure from the G7, because they're killing Germany too. And right? Germany is tied so much to China, but when you look to see who's killing it in the auto export world, it's China and Japan, and they're taking it right from the Germans. So how
and
the Germans,
hybrids, they're the hybrid revolution, like stealing a lot of market share from the EVs, right? So that's helping Japan too.
And being priced with 150 yen. I mean, you know, it's not a bad situation to be in. And more importantly, you got the euro yen And I know people get sick of me talking about it, but the euro yen is up to 163. These are big things.
Oh, just a final question, Larry, if it's okay, on your thoughts on emerging markets. I know you've been bullish on Brazil. If you're still bullish there, Indonesia, Colombia, Argentina, Kazakhstan, maybe your thoughts?
Well, first, Milei, his victory in Argentina is really bullish for Latin American equities because he's such a brilliant communicator, and Cristina and that government in Argentina was so corrupt. And so he's outing this nasty corruption that exists, throughout Latin America. And those have been market unfriendly governments. And so I think there's going to be a Melee contagion in a good way, where I think you got a Panama election in May, and I think that there's a good chance you get a market-friendly solution there, because Panama's moved to the left, and you got a lot of moves to the left in Chile and Peru and Colombia. So that's probably going to all move a little bit more to the right. In Brazil, Lula is like, he's got a pretty conservative legislature. So what happened was, it's kind of like Obama. Obama was a great president for a lot of reasons, but I mean, I'm a Republican. I didn't vote for him. He's a great president because he had the Republican control of the House and Senate. He led from the bench, from the Oval Office, and stocks really like that, and that's what you're seeing now in Brazil. And so I think China equities are really cheap. I love BABA here. I think that they're gonna. The problem is, when the Fed is so restrictive with rates and keeping rates up, it's strong dollar. It's not allowing China to ease the way they'd like. And so when the Fed starts cutting, it's gonna be good for China. And I like the EMLC, the Emerging Market Local Currency Bond Fund here. It's JP Morgan, EMLC. It's pays 6%, but when the Fed stops hiking and when they lean toward cutting, local currency bonds typically do really well. And a lot of those local currency bonds over the last couple of years, because of the strong dollar, have been hammered. And the funds bounce, but it's a portfolio of like 250 bonds that are Philippines, Brazil, a lot of different emerging market countries, but in local currency. And so in a weaker dollar regime, that's a fund that's going to give you a great yield and potentially some upside and appreciation.
Well, great. Yeah, that's great insight, great points on the emerging markets. And thank you very much for this discussion. How can our listeners and viewers learn more about your work?
Well, the book will be out on the shelves. Random House Penguin, big shout out to them. It's probably the best publisher in the world. When Markets Speak, and on Twitter we're at ConvertBond. Our website is lawrencegmcdonald.com, and there's lots of different ways. We'll be out. We'll be in New York for hosting events, March 18th to the 26th. And so, yeah, reach out to us, and we'd be happy. If you're an institutional investor, we'd be happy to put you in the chat. Or if you're an investor that wants a recap of the chat and to see the conversation the next day, Valentina at thebeartrapsreport.com, Valentina at thebeartrapsreport.com. She can put you on distribution.
Well, that's great. Awesome. And your final thoughts, Ira?
Oh, I'm not, I really haven't been blogging at all. So the only place I come to discuss is here. And these discussions usually are really worthwhile, not just for people who are going to listen to them, I think, but for myself, because here I get to talk with Larry and we get to trade ideas around and to see the way things work, and to get a broad perspective. And again, why is the broad perspective? It's not going to lead you to make money tomorrow, but it sure as hell may keep you out of some really great and disastrous trades when you're following the herd. So it's not herd-like. It thinks through, and this was a great pleasure because I really was glad to hear Larry's views on the Treasury, on the Fed. There's so many things that are in play, and they're in play big, regardless of what the equity market tells you at any given day. That's just money sloshing around looking for things. What's the underlying sense? And it's the way we covered the gold market. So let's look at it. And how is the gold able to slough off 2.5% overnight real yields? How is it? If you're not perplexed by that, well, you got to rethink a lot, because, you know, I thought in this environment we'd see gold back down in the 1580, 1620 area and get an opportunity. It hasn't happened. So who's playing with it here? And as I say to people, if that's the case, though, because everybody cites the reason gold doesn't break is because all the central banks are busy loading up on gold. So some people ask me, said, well, how much is the Fed buying? I said, not a dime's worth. The Fed doesn't buy gold. That's not going to happen. When you're the reserve currency of the world, you don't have to buy. Everybody's partaking of what you're pushing out there every day. But it does prompt me to ask a question. Well, then why is platinum so weak? Is the only precious metal that exists that banks know how to buy gold? So, you know, I need to see more convergence of things for me to be into certain camps. But we get there by having these conversations, because they don't get asked where most people are watching, you know, in the mainstream media, be it CNBC, or they don't have these conversations. So this is like a great pleasure, because I don't get to have these, but I appreciate it with Larry and everything that you bring to the table, Richard, so to make these doable. So thanks.
Yeah, thank
Yeah,
you
thanks,
so much.
gentlemen.
Yeah. Go ahead.
No, I'm gonna plug in and listen on when you do that with, I don't know who your guests, who's going to be sitting when you do that chat, the one you talked about. Is it just going to be, you're going to New York for that, right?
Yeah, we're going to do a cocktail party with some of the media and clients, and then we're going to do other types of events in the city. But yeah, the book launch is key, because to get on the New York Times list, you need to sell about 8,000 books in a week.
8,000?
So we were fortunate enough to do that with our first book,
Yeah.
The Colossal Failure of Common Sense. But we had the Lehman failure and all that attention. And so now, yeah, it's a big challenge to try to move that. So we've got a lot of work ahead of us.
Well, hopefully this will attract some viewers. I mean, if I was blogging, I would put it out there, but I don't know. We get a lot of views, so it may help foment book sales.
Great.
Great. Yeah. Thank you very much, Larry and Ira.
Thanks, Larry. Appreciate it. Thanks, Richard.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.